Morning, everybody. Thank you for joining. So today we've got a webinar on end of tax year. Obviously, tax year is coming up. End of tax year is coming up 5th of April. So it's good to get some kind of last minute things in before the end of the tax year, as well as some forward planning for the next tax year. So I believe we've got quite a few Crunch clients with us today. So thank you very much for coming. Hopefully we can continue this type of interaction with you guys, and hopefully you guys find it really useful. So first of all, introductions. My name's Ben. I manage the sales team here at Crunch, so I'm responsible for bringing on all the new clients that come through the door. And with me is Chris. So Chris is our senior accountancy manager. He's responsible for all the technical nuts and bolts accountancy advice and things like that. So like I say, today we've got 9 key tips for the end of the tax year. It's end of tax year, but also start of the new tax year as well. Now, the big thing that we're going to do at the end is a live Q&A. So on your widget that you should have with your GoToWebinar, there is a little drop down that you can click, which has got questions, and then you can type in a question at any time. It doesn't have to be now. It doesn't have to be at the end. You can type your question in, and hopefully Chris will be able to answer them live for you once we've gone through the slides. Any that we don't get to, we'll make sure we follow up with everyone, a kind of Q&A sheet after the webinar. But I think a good thing to mention now is that any advice or anything that we give you on this webinar via myself or Chris is for information purposes only. If you need bespoke advice and you are a client of ours, normal channels, get in touch with your client manager, get in touch with an accountant here at Crunch, and we can give you some more bespoke advice based on your own unique situation. Yeah. Right. So let's kick it off. So when we go through the slides, there's all sorts of recommended reading that we're going to give you. We're going to point you in the direction of knowledge articles. Now, if you're a client or not, this is a really great place to get some information. So we'll give you a full list of these knowledge articles once we've completed the webinar. We'll send them out to you via email as well. So what are the things that people need to do coming up for the end of the 17-18 tax year?
Okay, so the first main thing is to make sure you're being tax efficient. So as a director of your own limited company, it's important that you're issuing and paying both salary and dividends before the end of the tax year, which is the 5th of April. So provided you've got a personal allowance of 11,500 and you're taking the recommended salary of 8,164, you can issue up to 36,836 to utilise your basic rate. Obviously, if you have other income, this will slightly alter. However, if you had this scenario, then you would pay just over £2,000 in tax next January 19.
Great. Next bit on that, you've got another slide here.
Yes, so I just wanted to have a breakdown of how the 36 grand is broken down. So the first three and a bit thousand is tax-free and is part of your personal allowance. Then on top of that, you get a tax-free dividend allowance of £5,000. Then the remainder of the 36 grand, 20.5, is then taxed at 7.5%.
Okay, so that's tip number 1, making sure that people are taking dividend and salary. Absolutely. And you've still got time. You've still got 3 weeks or so. So if you do need to do that, you need any help being a client, get in touch with us and we can make sure that we point you in the right direction. So salary responsibilities, there's some kind of reporting responsibilities that people have got.
Yeah, so as well as making sure you're issuing and paying your salary before the 5th of April, it's also important if you've got employees that you're doing that for them as well. And additional to that, as we're at the end of the tax year, you need to make sure that you file your final payment, your final payroll with HMRC. If you don't do this, you'll get an automatic £100 fine. And then after the 19th of April, if you're still not submitted the correct salary, you have to amend your salary, and that might come at extra cost for you as well. So when submitting your payroll, even if you're doing it yourself or via a third party, just make sure they're submitting it and they're saying it's the final submission, okay?
Okay. Right, so other tax breaks that people might be able to take advantage of before the end of the year.
Yes, although we can't advise on pensions and investments, it's really important that you're still utilising both these allowances. So for ISAs, making sure you're putting the relevant amount into that before the end of the tax year. So it's actually the payment needs to go in before that date. And same with pensions. If you want to contribute into a pension, it's really important that you're doing that before the 5th of April, okay? And it's the payment that is done before that date.
So people don't need to be paying this in over the course of the year. They can make one lump sum payment in before 5th of April. Okay, that's really good. Right, expenses. Now, as someone that's bringing people on board, we get a lot of questions around expenses, and I think that's ongoing for our clients as well. So what can we do before the end of the tax year to make sure we've got all that tied off?
Absolutely. So to make sure you're issuing the right amount of dividends, it's really important that your accounting records are up to date. If you're using cloud software, Crunch, reconciling that. If you've got another accountant, make sure you're contacting them, providing your kind of expense receipts, claiming, passing on all your accounting records, and making sure you do that. Additionally, a lot of directors will have their normal year end being the end of March anyway. So it's a good kind of time for a bit of housekeeping, making sure everything is up to date.
And how long do people have to keep receipts for?
Up to 6 years, you need to keep it. You don't have to keep the actual receipts. They can be digital. So you could use your phone to take pictures, but there's a lot of great apps these days where you can kind of store them digitally through a receipt bank, for example. Crunch have their own called Snap. So just make sure you're recording them and then you can always go back to it if needed.
Okay, perfect. So they're the things that we need to be thinking about for the 17-18 year, but what can we be doing to get ahead of the curve, I suppose, for the 18-19 year?
Yes, so as well as working on this year, it's really important you're aware of the allowances for next year and other kind of changes. We didn't have that many changes this year, but there's a normal kind of rates you need to be aware of. So the government pledged they're increasing both the personal allowance and basic rates. So they're both increasing by small amounts. The basic rate has actually increased by quite a bit. So it was £45,000. Now it's 46,350. But just be aware that if your main income is salary and you live in Scotland, the rates now will be slightly different for you. Okay.
We do have some bits on that at the end of the webinar too, in terms of the Scottish stuff. So salary itself, if you're pulling that out of your limited company, what do we need to know for the new year?
Yeah, so for next year, if you take our recommended salary, it's 424 next year, which equates to £702 a month. However, that's not ideal for everyone. So if you've got company car, other benefits in kind, that might need to adjust. Additionally, if you've got employees, you might be able to claim something called the employment allowance. The employment allowance is where you can get the first £3,000 off your employer's national insurance. So therefore, if you've got yourself as a director and someone else, and one of those are earning more than 8,424, you can claim this allowance. It's quite complicated, so speak to your accountant and then we can give you really more bespoke advice on that.
Perfect. Dividend tax. So there's a few changes here. So what do people need to know?
So the main kind of negative in terms of government changes was there was a decrease in the tax-free dividend allowance. So it's decreasing from 5,000 to 2,000. Okay, so this will mean that you'll pay up to £225 more in tax for 18-19 year. However, that's offset with the increase in the personal allowance and the increase in the basic rate. Okay, so for next year, provided you take salary up to the primary threshold of 8,424, you can issue dividends just shy of £38,000 next year. Okay, and you'll still be utilising your basic rate, and dividends won't be taxed at any more than 7.5%. Okay.
Okay, so I guess the main takeaway is that although that the tax-free allowance is going down to £2,000, you have more available to take at that lower basic rate.
Exactly that. It's worth also mentioning that previous slide that if you take a salary above the 38,000 from next year, it'll be taxed at 32.5%. Okay, and if your income is above £100,000, you start losing your personal allowance. Okay.
Company cars, there's been some changes to the types of cars that are going to be beneficial to you. Is that right?
Absolutely. So since the dividend rules changed and this new 7.5% came in for basic rate, it can be quite an advantage to have a company car, especially if you've got one with low CO2 levels. However, if you've got a diesel car, you pay an extra supplement on that. And that supplement is increasing by an extra % from next year. Additionally, benefit in kind rates are increasing by a few % anyway across the board. However, it's not all bad news because the government has decided to bring in a new system from 2020 provisionally, where all the rates will be decreasing again. And instead, they're bringing in a new variable instead of just the CO2, where if you've got a hybrid vehicle, it's based on the range of that battery. Okay, so if you're looking to get a new company car, hybrid is the way forward. Okay. But it's still definitely worth these rate increase considering having a company car. Okay.
Childcare vouchers, again, some changes to this. This affects quite a few people, doesn't it?
Yes. So one of the main benefits of having a limited company is the fact that you can get childcare vouchers provided to you personally tax-free. So if you've got children nursery, that's really great because it comes out of your payslip. However, you have to join that scheme by the 5th of April 18, okay? Because there's now a new scheme in place called tax-free childcare. Positive of that one is the new scheme is available for self-employed as well as employed people. But generally the childcare voucher is the better scheme, not in every situation. So it's really good that if you've got children at nursery now or going to be imminently, set up the voucher scheme immediately, okay? Sure.
So like I say, if you've got any questions about anything that are popping up here, just get them into that questions box on the GoToWebinar widget, and we can answer them hopefully at the end. Student loans again affects a lot of people. What do we need to know for that?
So not everyone's aware of this, but with student loans and you're the director of your company, when you do your self-assessment, the amount of student loan you pay is based on all your income. From next April, those rates are changing slightly in a good way. So you start paying your student loan when you're earning more income. So depending on what plan you have, if your plan 2 is about 25k, you start paying student loan back, and for plan 1 it's around kind of 19,000.
Okay. Now we mentioned earlier on that there were some changes to the Scottish tax. In a nutshell, what do we need to know?
Yes, so it's only relevant if you're living in Scotland and you have employment income kind of up to kind of the basic rate amount. So if you're a limited company director with only a small salary, this won't affect you, okay? But say, for example, you had a PAY role and now you've gone limited. In that kind of transition year, you might pay more tax on that salary than you originally thought, okay? So from next year, there's now 2 new rates. There's a starter rate at 19%, and there's an intermediate rate at 21%. And additionally, the higher rated tax is increasing by percent as well. So it's 41% and 46% respectively.
Okay, perfect. So that brings us to the end of the slides, I suppose. We're going to share all of these slides with everyone that's attending, so you're going to have these to take away. But there's some really good recommended reading here for you, which, like I said at the start, links back to our knowledge section of our website. So again, you're going to get all of these links that come out if you want to do a little bit more reading, or if you want a little bit more information. So the Q&A, hopefully there's some questions that have come in and we can read through these now. So bear with us and we'll get some of your questions answered, I suppose. Let's have a quick look. Let's answer this one. So how much can I issue in tax-free dividends in 2017-18?
Yes. So assuming that you've got the salary of £8,164, the first £8,000, £8,366 is tax-free, okay? That utilises your personal allowance and the dividend allowance. And then the next 28,500 is at 7.5%.
Okay, so next one we've got is, can I take more in salary? I guess more than that kind of £8,000-ish that you mentioned earlier on.
Yeah, absolutely. So there's nothing stopping you, but it might not be tax efficient. So it's important that you speak to your accountant just to confirm that. And just issuing a higher salary doesn't necessarily mean you're going to be tax efficient. And the reason is because when you have a salary above that 8,000 mark, you start paying national insurance, okay? And even though it gets offset by the corporation tax relief, it's usually not as tax efficient.
Okay. Do the changes make a company car less attractive?
Obviously, you start paying a little bit more tax, but like I was saying, that if you withdrew profits as dividends, you would normally pay more tax than if you had a company car. So it's important really to consider the options, and based on the facts, then you can make a decision.
Perfect. Is it still going to be better off to be a limited company rather than a sole trader?
Yeah, good question. So although the government is trying to kind of reduce the gap between the two, based purely on the financials, it's still slightly better. So usually between, if your profits are between 30 and 120, then yes. However, there's lots of other different factors that you need to consider. Okay, so it's kind of the risk profile you have in terms of if your clients didn't pay you, then they can come after your own personal assets. The way your business structured. So if you've got quite a bit complicated structure or trading activity, so maybe you're doing something quite dangerous and for kind of insurance purposes, it might be worth having a limited company. So never look just at kind of the ultimate take-home pay. It's just useful to look kind of the wider picture as well. And even having a limited company makes it more kind of attractive in terms of increasing and growing your client base.
Great. Right. What about, will my account manager be able to give me advice on dividends? I've yet to take any dividends.
So with your kind of client manager, account manager, they'll be able to give you kind of the basic kind of information. So what I told you today, so issuing dividends up to 36 grand will utilize your basic rate. But if you want a more bespoke conversation, maybe because you have different other income, maybe you live abroad for some of the year, you've got a company car, then one of our accountants will go through the options for you and say exactly how much dividends you should issue. Okay.
Perfect. What about
let's do
this one?
Yeah, let's do the I-35.
So how about the impact of I-35? How does that affect your calculations?
Yeah, so that completely alters these calculations. Okay, so if you're inside of I-35, saying you work in the private sector, okay, then your the remuneration amount you paid will be based on the income you receive from your clients. So it effect will be a salary, so you have a very high salary. And then if you're private sector, because of the 5% allowance, you might have some leftover dividends, but not very much at all. So it'll pretty much be all salary for I-35 clients. Okay. And if you're in the public sector, it's probably even simpler in the fact that the client will deduct the tax at source, you see. So pretty much whatever left in the business, you'll be able to take without paying any extra tax. It only gets a little bit more complicated if you've got some clients inside I-35 and some that are outside. But like I said, if you've got anything that more complicated than that, get in touch with us and we can give you some bespoke advice on that.
Okay, so a childcare vouchers question. With regards to childcare vouchers, I've been paying these direct from my company and claiming as an expense. Is that still going to be the case in 18-19?
Yes, absolutely. So provided you are on a scheme at the moment, even now before the 5th of April, you can continue indefinitely, okay? So that does not change. And there's no guidance from HMRC saying when they're going to stop that. I would imagine they will at some point, but I would not imagine that would be for a few years.
Okay. What about this one? Can I issue dividends within my allowance based on profits if the funds are not immediately available in my bank account? In other words, I would make use of my 7.5% bracket this year by issuing dividends now, but only withdraw the funds when my new invoice comes in the next.
Excellent question. So HMRC deemed dividends to be kind of taxable at the point they're paid. So unfortunately, if you don't have the money available, then it'll be frowned upon by HMRC, and they would argue that dividend will actually be classified in next year. Okay. Every accountant gives slightly different advice and information on this, but we'd rather kind of advise based on HMRC's guidance. So it's always better to pay that dividend before the end of the tax year. Okay.
Okay. How about registering a limited company with one's children as stakeholders through money provided by them?
Yes, so that will be something that HMRC would deem as tax avoidance, okay? Unless the children were actually doing work for the business and contributing, then that's a possibility. But otherwise, if you are giving them shares for the pure reason of issuing dividends, then absolutely not. If you had a more complex structure where it was about recession planning and you wanted to pass the business over to your children in the future, you could give them different types of shares without dividends. That wouldn't be a problem. But it's the fact that if they were receiving dividends, it'll be a no-go.
Okay, got one about investments here through a company. As a company director, can I invest the company profit into bonds or mutual funds?
Yes, so this gets quite complicated, and the advice you get from your investor may be different from what the advice you get from your accountant. So speak to both parties and see what they say. But from a pure accounting point of view, if you have investments in your business, because your trading activity isn't investing in shares or what forth, you might be accidentally classed as an investment business, which means the rate of taxes you pay might be more, and also when you close the business you won't be able to claim entrepreneur's relief. Okay, so before you consider anything like this, even after you've spoken to a financial advisor, please speak to your accountant, because they might give you some more information around the tax legislation that you're not aware of. Okay.
I think this one might tie into this one as well. So how does holding bonds or shares affect your tax allowance, or does it even?
Yes, so it won't generally affect that. Okay, so with income you received from shares, so in terms of the capital gain, so the appreciation of a share, that will be taxed as a capital gain. Okay, so capital gains and income tax are taxed separately, so you have two separate allowances. Okay.
Okie doke. There's an expense-based question here around working from home. What's the annual cost amount I can claim for working at home through a limited company?
Yes, so as long as you're working home on substantive duty, so it's not just post, but you're actually doing your trading activity at home, you can claim £4 a week without a problem. You don't need to collect any evidence from that. Okay, if you want to claim more on that, it's HMRC generally don't allow that. However, if you set up a rental agreement with yourself and the business, then it's classed as a rental income, so different rules come into play. So therefore, you'll be able to claim a proportion of those expenses based on the number of hours that you work in that home on business hours compared to the number of hours in a day, the number of rooms. So it's quite complicated. We do have a rental expense calculator to help you out on that. But the most important thing, if you want to go down that route, is that you've spoken to a lawyer potentially, and you've got the rental agreement kind of set up in advance. Okay.
Okey-doke. I saw another one down here in relation to VAT. Has anything changed that affects whether it's worth becoming VAT registered or not, or which scheme you might want to join for 18-19?
Yeah, so there's no changes this year, thankfully, around VAT that affect that. But from last year, as you may remember, there were the rules around limited cost trader. So if you had not many expenses related to the services you provide, then you had to go on a higher flat rate scheme. Okay, so for the majority of our clients, it was better for them to either deregister if they were below the 85 grand threshold, or another idea was to go onto the standard scheme and reclaim input VAT expenses, VAT on your expenses as normal. Okay.
Okie doke. There's been a couple of questions coming around payroll, specifically for Crunch clients. So I'm a Crunch client. One final payroll and dividend taken at the end of this month. Does the Crunch system submit everything to HMRC, or do I have to take action to confirm the submissions to HMRC?
Okay, so slightly off from this, but it's still relevant, is when you're issuing payroll and dividends, it's very, very important that you can treat it as two separate transactions. Okay, so two bank payments. If you combine them all in one pot, HMRC would likely to deem it all as salary. Okay, right. So that's kind of the first point on there. In terms of dividends, you don't actually submit anything to HMRC until you do your self-assessment. Okay, and what is important is that you've got the legal paperwork behind that. When you submit a dividend with Crunch, the system will automatically create board minutes and dividend vouchers. Okay, they are kind of the proof that the dividends were issued. Okay, and alongside kind of your bank statement to show it's been paid, you've got the evidence you need. And then when you submit your self-assessment based on the legal paperwork, you then submit that, and that's when HMRC first know about the dividends you issue.
Okay, here we go. I'm a director in company A, where most of my income comes from. I have a small shareholding in company B. As of now, I'm unclear what dividend will be from company B. Ideally, I would like to ensure that my total of the 17-18 is 45k, but as a company B income is unknown as of today, that is not possible. If the dividend from company B is paid after the 5th of April, 18, will it be included in my 18-19 income or backdated to my 17-18 income?
Yeah, so for this kind of question that's quite complex, I'd really advise speaking to your accountant and give you bespoke advice, okay? What I would suggest to this individual is contact us separately and we can have a conversation around that, okay? Because there's a lot of variables that'll affect that, okay?
Sure thing. Right, anything else jumping out at you, Chris?
I think that
might cover it. So what we're going to do, if we haven't got to your question for whatever reason, we're going to follow up with everybody. Like I say, we're going to give you a copy of the slides. We're going to give you the recommended reading. We're going to give you a question and answer sheet with all the answers to all the kind of generic questions on there. But if there's anything that you need in your Crunch client, make sure that you get in touch with your client manager. They're your first point of contact.
Absolutely.
Always when using the service. What else? Final bits from us is that Crunch, client or not, one great thing that we've got available to everyone is called Crunch Chorus. It's free to join. It's a community where you can get all sorts of benefits, discounts on things like business insurance, free white papers, meetups that we have regularly. So definitely jump on there and register as well. And then lastly, our next webinar we've got coming up, we're going to be doing one in mid-April. It's about getting started with self-assessment. I think we're going to be doing that with a client manager as well. So all of you clients out there that might have an interest in that, we'll send you out a link probably following up after this webinar too. So look, thank you very much, everyone that's joined us today. Hopefully you got something out of that, and we'll speak to you soon.
Brilliant. Thank you very much. Bye-bye.
Cheers.